Hello everyone. Today we are going to continue our discussion on cost classification. In last class we saw 5 classification, that is on the basis of nature and on the basis of functions and on the basis of variability and on the basis of controllability. So here we will see the fifth one now, that is on the basis of normality. In that first one is a normal cost. What does it mean? It refers to the cost which are normally attained at a given level by conditions. Means these are the expected and usual cost incurred under standard operating conditions. If we produce a product, we need raw materials, we need wages, we need the laborers, we need workers, or we need electricity. Okay, so these all are the expected cost that incurred under standard operating conditions. Okay, that is called as normal cost. For example, raw material cost required for production, wages paid to the workers based on normal working hours, and electricity bill for regular machine operations. Means these are the normal cost. We know if we want to produce a product, these costs we will incur. That they are raw materials or wages we have to pay to the workers and electricity bill or other costs. And in that second one is abnormal cost. It means what? These are unexpected. Normal cost, they are expected, means we know. And what about abnormal cost? These are unexpected cost. Means we don't know about the costs, whether they will occur or not. So here abnormal cost means these are unexpected or unusual costs that arise due to unforeseen events. For example, losses due to fire, loss due to fire, and extra labor cost due to machine breakdown or poor handling. These are the unexpected costs, that is losses due to fire, or we need to pay the extra labor cost due to machine breakdown or poor handling, and material wastage due to defective production. So normal cost, they are the expected cost, and abnormal cost, they are unexpected cost. They arise due to unforeseen events or circumstances. Okay, so this is about on the basis of normality, that is normal and abnormal cost. Now we will see the sixth classification, that is on the basis of time. On the basis of time, in that first one is historical cost or actual cost. Okay, there are mainly 4 types. On the basis of time, they are historical cost or actual cost, predetermined cost or future cost, and estimated cost, and standard cost Okay, now first we will see that is historical cost or actual cost. Okay, what does it mean? It means these are actual costs incurred in the past. Means these are the costs, they are incurred in the past. That's why we will call it as a historical cost. Means they incurred when in the past. For example, the cost of machinery purchased in the last year. In the last year means in the past. And rent paid means, it means what? Means we have already paid the rent. Means these are the costs, they are incurred in the past. That is called as historical cost or actual cost. Clear? Now see the next one, second one, that is predetermined cost or future cost. What does it mean? This is the future cost, and these are the first one is historical cost. Okay, see here, it is the cost which is determined in advance before the actual operation starts. Okay, here predetermined cost, it means they are the cost which is determined in advance before the actual operation starts. Okay, it means what? If we want to produce a product or service, we have to determine in advance the cost they are going to incur in the future. Okay, this is called as future cost or predetermined cost. Here we have to determine in advance the cost they are incurred. Okay, so this is about predetermined cost and future cost. It may be either estimated or standard cost. Okay, in predetermined cost there are mainly two types. They are estimated or standard. Now we will see the estimated cost. It means what? Here estimated cost, it means it is prepared before accepting an order for submitting price quotation. Okay, see here this estimated cost, it means it is prepared, this estimated cost that we will determine before accepting an order. Before accepting the order, we have to determine the cost for submitting the price quotation. So it is prepared before accepting an order for submitting price quotation. Okay, here I will explain this cost through one example. See, a rough calculation that is based on the past data. Okay, so this estimated cost, it means it is a rough calculation that is based on the past data. Okay, so here means on the basis of past data, here we will prepare the price quotations. Here for example, a company, it plans to produce 1000 wooden tables next month. Okay, here company, it produce 1000 wooden tables. When? Next month. Clear? Next month. So based on the past data, estimated cost, it means what? A rough calculation based on the past data. Means here it is prepared before accepting an order for submitting the price quotation. Means here company that plans to produce 1000 wooden tables in the next month. So based on the past data, the estimation is, so based on the past data, the estimation is, see here, raw material cost per table, that is rupees 2000. Raw material cost per table, that is rupees 2000. And labor cost, okay, labor cost per table, that is rupees 400. And next one, overhead means expenses per table or cost per unit, that is rupees 300. That is rupees 300. So what is our total estimated cost? Here 2000 plus 400 plus 300. So our total estimated cost is, that is rupees 2700. Rupees 2700 is our estimated cost. Okay, clear? Rupees 2700 is our estimated cost. Means the total estimated cost of production is 2700 into 1000 wooden tables. Means that is rupees 27 lakh. That is rupees here. That is rupees 27 lakh. Clear? 27 lakh. Okay, 1 minute. Yes. That is rupees 27 lakh. So here if this actual cost that exceeds this estimate, actual cost exceeds this estimate, management that will analyze the variance and find the reasons for the difference. Okay, so this is about estimated cost. Okay, so estimated cost, it means what? It is prepared before accepting an order for submitting the price quotation. Means it is a rough calculation based on past data. Okay, now we will see the fourth one, that is standard cost. It means what? It is the budgeted cost of a regular manufacturing process against which actual costs are compared. Standard cost, it means it is the budgeted cost of a regular manufacturing process against which actual costs are compared. It means here, if a new product or service or process is to be carried out, the initial standard cost will have to be estimated. So here the standard cost, that is a predetermined cost set for materials, labor and overhead based on the efficiency level. Based on efficiency level. For example, see here, a company, it produces wooden chairs, sets the following standard cost per unit. Company produce wooden chairs. Wooden chairs. So the estimate, now we have to estimate the standard cost per unit. Here take raw material, it includes wood, nails or polish glue, okay, that is rupees 800. Next one, direct labor, that is rupees 300. For example, you take 2 hours at rupees 150 per hour, that is rupees 300. Next one, overhead, means expenses, that is factory rent or electricity or maintenance per unit, okay, that is rupees 200. So total standard cost is, that is 1000 rupees 1300. This is standard cost per unit, that per chair, wooden chair, that is rupees 1300. Here if the actual cost per chair turns out to be 1400. Standard cost is 1300, but here the actual cost that turns out, that is rupees 1400. Here the company will analyze rupees 200 variance to find the cost. Okay, this is about standard cost. Means here we will standard cost, that is based on the efficiency level. Standard cost, that is based on the efficiency level, and the estimated cost, that is based on past data. Here estimated cost, that is based on the past data. Clear? So these are the classifications on the basis of time. They are historical cost, means the cost that are incurred in the past, and next one, predetermined cost or future cost. It is the cost that is determined in advance before the actual operation starts. Next one, estimated cost. In the two types, estimated cost and the standard cost. Okay, I hope this is clear to you all. Now we will see the next classification. Okay, that is on the basis of in relation to the product. On the basis of in relation to the product. In that first one is direct cost. Direct cost. Okay, or product cost. Direct cost, or here we can write down product cost also, or product cost. What does it mean? It means these are the costs, they are directly related to the production of goods or services and are included in inventory valuation, means stock valuation. These are incurred only when production take place. Here direct costs are termed as product cost. What does it mean? It means these are the costs, they are directly related to the production of goods or services. Means these costs, they are incurred only when there is a production. Only when there is production. They are directly used in relation to the production of goods or services, or they are directly related to the production of goods or services. This is called as direct cost. Clear? Now here for example of direct cost are cost of raw materials. They are the direct cost used in production. And second one, direct labor cost. They are the wages paid to the workers for production. Okay, so first one is direct material cost and second one is direct labor cost. And third one is factory overhead. It means the expenses like electricity and depreciation of machinery, factory rent. These are all are the expenses of direct cost. Clear? So the examples of direct cost are direct material cost, direct labor cost and factory overheads. Okay, so these are the examples of direct cost, means they are directly related to the production of goods or services. Goods or services. Next one, indirect cost. Indirect cost, these are the costs not directly related to production and are charged as expenses in the period they are incurred. So they are called as period cost. So indirect cost or period cost. Okay. So here means these are the costs, they are not directly related to the production and they are charged as the expenses. For example, office salaries, rent, utilities, advertisement, sales commission. Okay, these all are not directly related to the production. So they are charged as expenses. Office salaries means we are paying to the workers, and rent we are paying to the building or machines or equipments, utilities, advertisement, sales commission. Okay, so these all are the examples of indirect cost. So on the basis of in relation to the product, there are mainly two types. First one direct cost and second one is indirect cost. Next, last classification, that is on the basis of cost analysis for decision making. On the basis of cost analysis for decision making. There are mainly four types. They are relevant cost, marginal costing, incremental costing and opportunity cost. Okay, now we will see first one, that is relevant cost. It means costs that are affected by decisions are called relevant cost. Relevant cost means what? They are affected by decisions are called as relevant cost. Means we have to decide whether the cost they are relevant or irrelevant. Okay, I will explain this relevant cost through one example. Take a bakery, it receives a special request to make 50 custom cakes. Bakery receives 50 customs cake. For what? For a wedding. Okay, the bakery needs to decide whether to accept the order at rupees 400 per cake. At rupees 400 per cake. Okay, here a bakery receives a special request to make a 50 customs cakes for wedding, and here they have to decide whether to accept this order at rupees 400 per cake. For that, what they have to do, they have to determine the relevant costs they are going to incur. So write down here, take the cost items, they like flour. For flour, sugar and eggs. That is rupees 150 per cake. These are relevant or irrelevant. So these are the relevant cost. And next one, direct labor. Direct labor, that is rupees 100 per cake. These are relevant or irrelevant. These are also relevant cost. Next one, extra decoration. Extra decoration, that is rupees 50, and these are also relevant cost. Next one, fixed rent. Fixed rent, it means already paid, so that it is not included in the relevant cost list. Okay, already paid fixed rent, that is rupees 200, so it is the irrelevant cost. And next one, regular making expenses. Regular making expenses, that is rupees 50. That is also irrelevant cost, because these regular making expenses, they will incur whether they have received the order or not. Okay, so these are the expenses they will incur on the daily basis. Okay, so this cost is irrelevant. Here fixed rent and regular making expenses, they are irrelevant. So here rupees 150 direct labor and extra decoration, that is rupees 50, means rupees 300. Rupees 300, that is our total relevant cost. So our total relevant cost is, that is rupees 300. But our order price is, that is rupees 400 per cake. Now we have to decide whether we have to accept this order or not. Here, since the price is greater, means that is rupees 400, that is greater than the relevant cost, that is rupees 300. So the bakery, it should accept the order as it covers the additional cost and earns rupees 100 per cake. Means that is the rupees 100 per cake, that is the profit for the bakery. Clear? Means relevant cost means cost they are affected by decisions. Okay, they are called as relevant cost. Now we will see the second one, that is marginal costing. It refers to the additional cost incurred to produce one extra unit of a product. It includes only the variable cost like direct material, direct labor and variable overheads, while fixed costs remain unchanged in the short run. Marginal costing, it means the additional cost incurred to produce one extra unit of a product. Okay, means if the company that produces 100 chairs per month and they are planning to produce 101 products per month, 101 chairs per month, means the additional cost incurred to produce one extra unit of a product, that is called as marginal costing. Before, companies used to produce 100 chairs per month. Now it is planning to produce 101 chairs per month. So if we produce 101 chairs per month, the cost incurred to produce that one extra unit of a product, that is called as marginal costing. Here that includes only the variable cost like direct material, direct labor and variable overheads. Here the fixed cost, they remain unchanged in the short run. Clear? Now see the third one, that is incremental costing. Incremental costing, it means what? It is a decision making technique that considers the additional cost incurred when choosing one alternative over another. Clear? It means what? Here it is a cost incurred when choosing one alternative over another. For example, a factory, it produces 500 tables per month and the management decides to increase the production to 510 tables. Marginal costing means what? The cost incurred to produce one extra unit. Here incremental cost means what? Additional cost incurred when choosing one alternative over another, means 500 tables per month. The factory used to produce 500 tables per month, 500 tables per month, and they are planning to produce 510. In marginal costing, only one extra unit. But here additional cost incurred when choosing one alternative over the other. Here 510 tables per month. Okay, so here the cost details are See, wood and materials. Wood and materials. Here current cost means when we used to produce 500 tables per month, that time the cost of wood and material is rupees 50,000. And after increase the cost will change. Means after increase the cost it becomes that is rupees 51,000. Now what is the incremental cost here? Incremental cost is that is rupees 1,000. 51,000 minus 50,000. And next take labor cost. Take labor cost. When the company is used to produce 500 tables per month, the labor cost is rupees 30,000. But when they plan to increase the production, then the labor cost is rupees 30,600. So our incremental cost is rupees 600. Next one, fixed cost. When the company is used to produce 500 tables per month, the current fixed cost that is rupees 20,000, and after increase the fixed cost that is also 20,000, means incremental cost is 0, means that is unchanged here. So after determining the incremental cost, the next step is to decide whether the decision is profitable or not. Here the company they has to decide whether the decision is profitable or not. Okay, this is about incremental costing. I hope this is clear. Next, last that is opportunity cost. Fourth one is opportunity cost. It is the benefit foregone when choosing one alternative over another. It represents the next best alternative that is sacrificed due to a decision. Means it is the benefit you lose when you choose one option over another. It is the benefit you lose when you choose one option over another. That is called as opportunity cost. For example, a company has rupees 10 lakh and it has two options, that is buy a new machine to increase production, that is expected profit that is take as rupees 1.5 lakh per year, or by using 10 lakh rupees they invest in bonds with guaranteed returns of rupees 2 lakh per year. So now what is the company's decision? If the company decides to buy the machine, the opportunity cost is here, that is rupees 2 lakh, the foregone profit from the bonds. And if the company choose the second option, that is investing in bonds, the opportunity cost is that is rupees 1.5 lakh per year, that is buying a new machine. Okay, this is the opportunity cost, means the benefit you lose when you choose the one option over another, means it is the benefit foregone when choosing one alternative over another. It represents the next best alternative that is sacrificed due to a decision. Okay, this is about opportunity cost. So on the basis of decision making, the cost they are classified into 4 types. They are relevant cost, marginal costing, incremental costing and opportunity cost. So these are the 8 classifications of cost. That is, first one on the basis of function, on the basis of, first one on the basis of nature, sorry, that is material, labor and expenses. Second one is on the basis of function, that is production cost, administration cost and selling cost, distribution cost, research and development cost. And on the third type is on the basis of variability. In that 2 types, fixed cost and variable cost. And 3 types. Third one is semi-fixed or semi-variable cost. And fourth classification is that is on the basis of controllability. That is controllable cost and uncontrollable cost. And fifth classification is on the basis of normality. That first one is normal cost and second one is abnormal cost. And sixth classification is on the basis of time. In that first one is historical cost, predetermined cost, estimated cost and standard cost. Next one, seventh classification, that is on the basis of in relation to the product. That is two types, indirect or product cost. Second one is indirect cost, direct cost or product cost. Second one is indirect cost or period cost. And last classification, that is on the basis of cost analysis for decision making. That is relevant cost, marginal costing, incremental costing and opportunity cost. Okay, so I hope this classification of cost topic is clear to you all. If not, please leave a comment.